Hello everyone, Graham here. In the world of personal finance, few things are as crucial as maintaining a good credit score. It's the key to unlocking lower interest rates on loans, securing better rental agreements, and even landing certain jobs. But here's the thing. You might be shocked to learn that some everyday habits are secretly damaging your credit score. In this video, we're diving deep into 5 surprising things you could be doing right now that are absolutely tanking your credit, and more importantly, how to fix them. Let's talk about those tempting credit card offers with amazing sign-up bonuses. You know, the ones promising thousands of miles or cash back. They seem like a dream come true, right? Imagine all the free flights, hotel stays, and cash rewards you could rack up. It's almost too good to pass up. But hold on a second. Before you start filling out those applications, let's take a closer look at what you're really getting into. It's easy to get caught up in the excitement, but applying for multiple credit cards in a short period can actually hurt your credit score. You might think that having more credit cards means more financial freedom, but that's not always the case. Each application you submit can have a significant impact on your credit score, and not in a good way. Every time you apply for a new credit card, the lender hits your credit report with what's called a hard inquiry. This isn't just a casual check, it's a deep dive into your credit history. Lenders use this information to assess your creditworthiness and determine whether you're a good candidate for a new line of credit. Think of hard inquiries as a little red flag on your credit report. Each one signals to potential lenders that you're actively seeking new credit. While 1 or 2 inquiries might not raise any eyebrows, a flurry of them in a short period can be a cause for concern. 1 or 2 hard inquiries here and there won't make a huge difference, but a bunch of them in a short time frame can make lenders think you're desperate for credit, which can be a red flag. Lenders might start to wonder why you're suddenly in need of so much credit. Are you facing financial difficulties? Are you planning to take on more debt than you can handle? They might assume you're in a tight financial spot and are more likely to default on your debts. This assumption can lead to higher interest rates, lower credit limits, or even outright denial of your application. It's a risk that many lenders aren't willing to take. Remember, lenders want to see responsible credit behavior, and constantly applying for new credit doesn't exactly scream responsible. They want to see that you can manage your existing credit lines effectively before extending you more credit. This means making timely payments, keeping your balances low, and not overextending yourself. Instead of applying for every credit card that catches your eye, be strategic. Take the time to research and compare different credit card offers. Look for cards that offer rewards and benefits that align with your financial goals and spending habits. This way, you can maximize the value you get from each card without jeopardizing your credit score. Focus on cards that align with your spending habits and offer rewards that truly benefit you. For example, if you travel frequently, a card that offers travel rewards and perks might be a good fit. If you prefer cash back, look for a card that offers a high cash back rate on the types of purchases you make most often. By being selective and strategic, you can build a strong credit profile and enjoy the benefits of credit card rewards without the drawbacks. It's also important to understand the terms and conditions of each credit card offer. Some cards come with high annual fees, while others might have introductory rates that skyrocket after a few months. Make sure you read the fine print and understand what you're signing up for. This will help you avoid any unpleasant surprises down the road. Interest rates are another crucial factor to consider. While some credit cards offer 0% interest for an introductory period, the rates can jump significantly once that period ends. If you carry a balance on your card, high interest rates can quickly negate any rewards you earn. Always aim to pay off your balance in full each month to avoid interest charges and keep your credit score in good shape. Setting up automatic payments can be a great way to ensure you never miss a payment. Late payments can have a negative impact on your credit score and result in hefty fees. By automating your payments, you can stay on top of your credit card bills and maintain a positive payment history. Regularly monitoring your credit score is also a good practice. There are many free tools and services available that allow you to check your credit score and report. Keeping an eye on your credit can help you spot any errors or fraudulent activity early on, giving you the chance to address issues before they become major problems. Using credit cards responsibly is all about balance. It's about finding the right cards that offer the best rewards for your lifestyle, while also managing your credit wisely. This means not only paying your bills on time but also keeping your credit utilization low. Credit utilization is the ratio of your credit card balances to your credit limits. and it's a key factor in determining your credit score. Budgeting is another essential aspect of responsible credit card use. By creating and sticking to a budget, you can ensure that you're not overspending and that you have enough funds to pay off your credit card balances each month. This will help you avoid debt and maintain a healthy credit score. Reviewing your credit card statements regularly is also important. This allows you to keep track of your spending, spot any unauthorized charges, and ensure that you're staying within your budget. If you notice any discrepancies, contact your credit card issuer immediately to resolve the issue. Achieving financial milestones, such as paying off credit card debt or reaching a high credit score, can be incredibly rewarding. These accomplishments can open up new opportunities, such as qualifying for better loan rates or being approved for premium credit cards with even more benefits. Finally, don't forget to enjoy the rewards you've earned. Whether it's a free flight, a hotel stay, or cashback, make sure to take advantage of the benefits that come with responsible credit card use. After all, the goal is to enhance your financial well-being and enjoy the perks along the way. In conclusion, while credit card offers with enticing sign-up bonuses can be tempting, it's important to approach them with caution. By being strategic, understanding the terms and conditions, and using credit responsibly, you can build a strong credit profile and enjoy the rewards without the risks. So, the next time you receive a credit card offer in the mail, take a moment to consider whether it's truly the right fit for you and your financial goals. Now let's talk about credit utilization. This refers to the amount of credit you're using compared to your total available credit. It's a major factor in determining your credit score, and keeping it low is key. Ideally, you want to keep your credit utilization below 30%. For example, if you have a credit card with a $10,000 limit, try to keep your balance below $3,000. High credit utilization can signal to lenders that you're relying too heavily on credit, which can make them think twice about lending you more money. They might see you as a higher risk, even if you're making your payments on time. To lower your credit utilization, focus on paying down your balances as quickly as possible. Consider making more than the minimum payment each month or exploring balance transfer options to consolidate your debt at a lower interest rate. You might have heard that closing old credit card accounts can help improve your credit score, but that's actually a common misconception. In reality, closing old accounts can actually hurt your score, especially if they have a good payment history. Here's why. Closing old accounts shortens your credit history, which is a factor that lenders consider when evaluating your creditworthiness. A longer credit history demonstrates financial responsibility over time, while a shorter history can make you appear riskier. Additionally, closing old accounts can increase your credit utilization ratio, especially if you're closing cards with high credit limits. This is because your total available credit decreases when you close an account, even if you're not actively using it. Instead of closing old accounts, consider keeping them open and using them occasionally to keep them active. Just make a small purchase every few months and pay it off in full to avoid interest charges. Co-signing a loan for a friend or family member might seem like a kind gesture, but it can have serious consequences for your credit score. When you co-sign a loan, you're essentially agreeing to be equally responsible for the debt. That means if the primary borrower misses a payment or defaults on the loan, it will directly impact your credit score as well. Lenders don't care if you weren't the one who missed the payment, they'll hold you accountable just like the primary borrower. This can be especially risky if you're not closely involved in the borrower's finances. You might not even be aware of missed payments until the damage to your credit is already done. Before you agree to co-sign a loan, carefully consider the risks involved. Make sure you trust the borrower implicitly and are comfortable with the possibility of taking on the debt yourself if necessary. This one might seem obvious, but it's worth emphasizing. Missing payments on your bills, whether it's a credit card, loan, or even a utility bill, can have a devastating impact on your credit score. Payment history is the most significant factor in credit score calculations, accounting for a large portion of your overall score. Even a single missed payment can send your score plummeting, and the negative impact can linger for years. Late payments stay on your credit report for up to 7 years, making it harder to qualify for loans, credit cards, and even apartments in the future. To avoid missed payments, set up automatic payments or reminders to ensure you never miss a due date. If you're struggling to make ends meet, Reach out to your creditors as soon as possible to explore payment arrangements or hardship programs. So there you have it, 5 surprising habits that could be secretly tanking your credit score. Remember, maintaining a good credit score is crucial for financial success. And it all starts with understanding the factors that influence it. Take some time to review your credit habits and make any necessary adjustments to improve your financial well-being. Thanks for watching, and don't forget to like and subscribe for more financial tips.